Good morning, everyone. Welcome to the Construction CPA's Coffee Cafe. I am the Construction CPA, Lisa Raish. We are dropping the hammer on cash flow problems so you can build things that matter. This morning's topic is tax considerations for your construction business. So we're actually going to talk about a number of different kind of different aspects of tax considerations. There are a lot of different things to think about and it's not just income tax. It's kind of a slew of taxes that you could potentially be subject to. Not everyone is. So we just want to kind of walk through the different things to think about when you are either starting your business or maybe you've been in business for a while. And, those are the kinds of things that creep up after you start to grow and you add people or things are changing in your business. So there are just some things to think about. And we're going to kind of walk through each and every one of them. And if you have any questions, please feel free to drop them in the chat. All right. So first, there are going to be some different types of taxes, right? So you're going to have your income tax, and that's the one that most people are most familiar with, right? That's the one that you get your tax return done in January, February, March, April of the next year for the prior year. That's what people are most familiar with, right? That's the one that tends to get talked about the most. What's going to be your income tax liability on the federal level? Are you in a state that is actually subject to income tax? There are 5 states in this country that actually are not. So that may not be a consideration for some states, but a majority of the states is going to be some type of income tax. So what do you need to think about for you as an individual owner as well as your business, right? So are you subject to some level of federal or state income tax? If you have employees, you're going to be subject to payroll taxes. And again, you're going to be subject to various payroll taxes. There'll be payroll taxes on the federal level, typically payroll taxes on the state level. In some cases, depending on the state that you're in, there might be a county level or a city level. So those are things that you want to make sure that you are familiar with. What are the obligations in the state that you're in, not only for you as the business owner, but what would your employees be liable for? Because in some cases, you're going to need to withhold on behalf of the employee and then remit to the various taxing authorities. So payroll taxes, that's a big one, especially when you start to hire employees. Or maybe you are the first and the only employee in your business. Again, you as an individual would be subject to payroll taxes in your business. Sales tax and use tax. So sales tax can be something depending on the state you're in. So again, this is going to be state driven. This is not all states. This is going to be specific to a state that you're in. You may be subject to sales tax on what it is that you are selling. So sales tax is very state specific, again, can be specific all the way down to the county or even a city level. So you want to make sure you understand what your obligations may potentially be on that state level or that county or city level with regard to the business that you're in. The other thing you could potentially be subject to is what's called use tax. And use tax is basically you should have paid sales tax on it. Had you purchased it in an area where there was sales tax, and you need to basically pay use tax to the state that you're actually in. So for those of you who might be let's just say in areas that are on borders of states, that tends to be an issue a lot of times where you'll go into the next state or the state on the side of you and purchase something. Maybe you did it in order to not pay sales tax on it. The reality is that you need to pay sale or use tax on it to the state that you're in. So the sales and the use tax rules are going to be state and locality specific. So you want to make sure that you understand where you're located and what drives the rules there, whatever they may or may not be. Again, some states, you're just going to have a state sales tax. There are going to be other states where you're going to get down to city, county level, and you want to, or even sometimes, fire district level, for example, like even deeper into a county. So you just want to make sure that you understand what your obligations are based on where you have your business located. Another thing to think about is property taxes, right? So for instance, when you're purchasing equipment, you are going to typically are paying some type of sales tax on the purchase of that equipment. But if you have that equipment based in an area, many states or many counties or cities are going to charge you property tax on it, or an excise tax. Sometimes that's what it's called. The easiest thing to kind of equate it to is, or think about it, when most states have, you buy a car in your state or your truck or one of your dump trucks, you buy a vehicle in your state, you pay sales tax when you are purchasing the vehicle, but then every year you get what's called a excise tax or a property tax bill for them for having that vehicle in that city, that county, that part of the state, whatever it happens to be. So you may be subject to these periodic taxes on the actual equipment that you own from the city or the county that you're in. So again, very different taxes, but all things that you could potentially be subject to depending on where you're located, the state that you're in, the city that you're in, etc. So income tax, payroll tax, sales and use tax, property tax, all very different things, but those are all different types of taxes that you need to consider when you're thinking about your business. And then the last really is how does your actual legal organization of your entity flow into each one of these things as well. So for instance, what's the difference between a sole prop or an LLC or an S corp? There are going to be tax implications for each one or each type of those entities. So how does that affect you? Are you operating as a sole proprietor? If you are, you will be subject to income tax, which we just talked about, but you will also potentially be subject to self-employment tax. So that's an additional tax to think about. As an LLC, the LLC does not exist for tax purposes. It's simply a legal vehicle. So you choose how you're taxed. So again, if you're a single member LLC, one person, you automatically default to being a sole proprietor for tax purposes. So again, you might be subject to self-employment tax. But if you have an LLC and you check the box and you'd like to be taxed as an S corp, you would not be subject to self-employment tax on the profits. There's going to be pass through. You're going to pay income tax on the pass through. So there's going to be different implications on how you're taxed for income tax purposes, depending on the type of entity you choose. So it's income tax. It's the type of entity you choose and how that income tax is getting charged. It's going to be payroll taxes, sales and use tax, and property tax. So those are just a number of taxes that you want to make sure that you think about. Again, the kind of default one that most people think of when we talk or we say the word tax is the income tax, but there are other things to consider as well. Now, we've talked about cash versus accrual accounting methods before. Each choosing which one that you want to go with is going to also have an effect on your overall tax liability, your income tax liability, potentially your sales tax liability, all of those different things. So what are the implications of you being cash basis versus accrual basis? We've talked about both on a very simplistic way. Cash is going to be the easier one to get around in. It's kind of dollars in, dollars out on a very basic level. Your accrual is going to be a little bit more complex to keep track of, but you're basically matching your revenues as you earn them with the expenses as you incur those expenses. So again, there are advantages to each one. It's going to ultimately determine the type of business that you have, what exactly you're doing, how you're doing it, which one makes sense or makes more sense for your business. There's no, this is the better one, that's the better one. It's not a one size fits all. So again, how does cash basis versus accrual potentially impact you from an income tax perspective, right? Is it better for you to be cash basis where it's dollars in, dollars out, or does it make sense to kind of match your revenue and your expenses together, regardless of where the cash is flowed in or out? and determining your income tax liability. So again, which one is more advantageous for you and your business, and not necessarily a lump of all businesses, because one might be better for one individual and so on. So when we're talking about tax considerations, especially in construction, one of the big things, one of the big drivers is depreciation. So the equipment that is purchased in construction can be incredibly expensive. There are also opportunities to accelerate the depreciation. So instead of taking it equally over the period or the life of that asset, can you accelerate the depreciation, take all of it on the front end or a very large portion of it on the front end where it's accelerated, right? Which will ultimately reduce your tax liability in the early years. But when you get to the back end years of those construction assets, there's less and less depreciation available to you. And therefore, the expense or the depreciation expense that you had received in the first year or two of that asset have gone away. And now, again, so now you've potentially decreased your income tax liability in year one, but now you took all of that expense in year one and you've got very little expense in, say, years 3 and 4. So again, there's a consideration that you need to make. Does it make sense for you to do that? Does it make sense for you to front load all of that expense, or are you going to need that expense in subsequent years? So that goes into determining how you should ultimately depreciate your assets. So again, you hear people talk about Section 179 depreciation. That's where you have the ability to depreciate all of the asset. Again, there are ultimately overall dollar limits that you will be subject to. There will be other limits, for example, whether you have losses in your business and so on. So again, things to consider, but are tax considerations when you're thinking about what your overall liability may potentially be in one year versus another. The other thing is just managing your job costs and managing your overall deductions, right? Are you maximizing the deductions that will help you decrease your tax liability, right? Will give you additional expenses to not, again, you don't want to drive your profits down that low because you do want to be profitable, but are you maximizing your deductions, right? Are you, when you are buying a vehicle, is it more advantageous for you to go depreciation method, or should you go the route where you take mileage, right? Which one is more like what's the better option for you? And those are the things that you want to think about when you are thinking about your deductions, right? Are you ensuring that you're getting all of the expenses? One of the things that we tend to run into when we start to take over the accounting for clients when they've just started out, or they started out and they were doing their own accounting, is in some cases they weren't maximizing their deductions because there were things that they weren't taking as deductions that they could have. So again, you want to make sure that you understand what can be deducted, when it can be deducted, how much can be deducted. You know, for instance, everybody loves to use, you know, it was a meal, a deduction. I took somebody out for dinner. It's a deduction. Well, yes, if you are taking somebody out for a meal and you are discussing business, there is a deduction there, but you don't get 100% of that. You only get 50% of your meal. So again, making assumptions about certain deductions may not be to your benefit. So maximizing them, ensuring that, for example, if you are accrual basis and you need to match your revenues with your expenses, you are in fact incurring or including all of the expenses associated with a project or a job or a year in that appropriate year, so that you have the expense against that revenue. So again, making sure that you are keeping track of your expenses, depending on how, I mean, you want to keep track of your expenses regardless, but ensuring that all of your costs related to a job are included, and they're included in the correct period. Because if they aren't included in the correct period, then it will also, and the end of the day, make the jobs look off, like your jobs are off, where they're over budget, under budget, et cetera, et cetera. So you want to make sure that you are accurately tracking your job costing in the correct period to include the correct year, so that it doesn't ultimately throw off any of your other numbers. Employment taxes, this is going back to your payroll taxes, and then your independent contractors, right? So there are going to be different tax considerations. For example, an employee, somebody who you pay very, regularly every week, typically in construction, it's going to be every week, every other week, twice a month. You're withholding income tax on the federal and state level for them. So you have federal withholding, you're going to have possibly state withholding if there's income tax in the state that you're located in. There's going to be FICA, Social Security, which most people are aware of. You're going to have that withholding, and you are going to be, as the employer, liable for collecting that withholding and then remitting it on behalf of the employee. So when it comes to the difference between an employee versus a contractor, when you have an employee, you're going to be subject to payroll taxes on the federal and the state level, like we talked about earlier. Now, if you have a contractor, you're not subject to payroll taxes. That particular contractor is subject to their own income and self-employment tax, not necessarily you. So again, distinguishing between which is which and which one, how they're being taxed. If you are controlling what this individual is doing, you're going to have an employee. You're going to be subject to employment tax, payroll taxes, again, paying those very regularly, every period, at the end of a quarter, at the end of the year, et cetera. With your subcontractor or your independent contractor, you're simply going to pay them for their services, and then they are going to potentially be liable for any of their own income tax, self-employment tax, and so on. So you're going to have different responsibilities. So one of the things that's kind of a default in many cases in construction is, we see it all the time, contractors don't want to pay the employment taxes and therefore are automatically make this the assumption or the conclusion that the people working for them are independent contractors, and then they're subject to paying their own income and self-employment taxes and so on. That may or may not be correct. So again, what are the implications of choosing between a contractor and an employee? There's going to be different things that you're going to be, for lack of a better word, on the hook for. So you want to make sure that you are aware of what they are, but it's ultimately going to have implications for you from a tax perspective as to what you are subject to, what your liability is, what your requirements are from a compliance standpoint. For example, there are going to be tax compliance filings that are going to need to be made quarterly if you have employees, and then also at year end to include the W-2 they would receive. On the other side of it, from a tax compliance perspective, a contractor simply is getting a 1099 form from you after the close of the year. Again, there's different things to think about. There's different compliance to think. You may not be subject to any tax, but there going to be tax compliance that you need to think about and you might be subject to. And again, there's always potential for credits. So one of the credits that we tend to see in construction, depending on the type of construction you're doing, is R&D credits for companies that are operating and offering or creating innovative construction methods, right? They're kind of going outside the box when they are doing their construction and creating new ways to do the construction. So there's an opportunity for credits, and they can be very lucrative credits if that is actually something that you potentially fall into. So you want to make sure that you understand, are there credits available to me, right? This isn't just what's my tax liability, but there might be credits. Are there energy efficiency credits? Are you building residential and commercial buildings that are energy efficient? They're certified energy efficient. There may be credits available to you as the builder of those projects for you to reduce ultimately your tax liability. So are there credits available to you? There are a handful of payroll credits that are available For example, the work opportunity tax credit is available should you hire in individuals that are considered high risk. For example, if you hire as employees individuals that are, ex-cons, that have come out of jail, who have come out of prison. Are you hiring veterans? So there are, again, rules around, do you have the ability to, are you hiring these individuals? If you are, there might potentially be credits available to you. So it's not just, hey, what's my tax liability in March when I file my tax return? It's, am I maximizing my tax deductions? And hey, are there credits available for me to reduce my tax liability? So there's a lot of different things when we talk about tax considerations. It's not just, oh, hey, what's my tax liability on my income tax return? Are there credits that are available to me as a business owner? Again, those are not the only credits on the planet. There may be other ones you may potentially be eligible for, but you want to make sure that you're thinking about what credits could be out there for you as a business owner to reduce your tax liability. And, at the end of the day, you want to make sure that you're looking at all of these strategies on an annual basis. We typically work with clients in the latter part of the year to look at what might be eligible to them for the next year, because there's typically planning that goes into this. So we don't do tax planning in December for the year that we're in. We do tax planning in December for the next year. So you're not running out. And for example, we see it all the time, running out the last week of December and trying to buy a bunch of vehicles to get depreciation on, or accelerated depreciation on all the purchase of these vehicles and reduce your tax liability. That's not necessarily tax planning. What you want to do is look at all the different things that we discussed. Are you eligible for tax credits? If you are, there is potentially some work that's going to go into compiling that information. You may need to accumulate that information over a period of time. So you want to make sure that you're looking at the options available to you ahead of time instead of scrambling to figure out if there's something that, instead of getting the scraps, let's look at what's on the table in advance and see what we can take from the table and put into, your overall tax liabilities for the next year. So again, you want to make sure you're doing your tax planning in the prior year for the next year, right? Scrambling at year end to think about what you might be able to do in order to reduce your tax liability typically does not get you the result that you're hoping for. Doing that planning in advance. We always recommend that you work with someone, a tax professional of some kind, to make sure that you are, in fact, getting the deductions, the exemptions, the credits, whatever's available to you, that you are really going through that list of things that you could potentially be available to you, exhausting that list if possible, and seeing what is available to you at that time for that year. You may be eligible for something this year that you may not be eligible for next year. So you want to get ahead of that, and you want to work with a tax professional, whether you work with a CPA or even an enrolled agent. Your enrolled agents they know tax, and that's what they do. They are licensed with the IRS, so they know the tax code. So CPAs and EAs are the people that you want to go to for your tax planning to ensure that you are getting the deductions, the credits, the exemptions, et cetera, that you could potentially be eligible for, and you're maximizing those in the years that you could potentially get them. If you have any questions whatsoever about what we talked about today, we'd love to hear from you. Drop your questions in the chat. We always look forward to seeing you here every Friday morning. As always, I hope you had a wonderful week. You have a wonderful upcoming weekend, and we'll see you here next week on the Construction CPA's Coffee Cafe.